Welcome traders, Maciej here from Taurus Trading. In this video you will learn how to trade using moving averages, so stay tuned. A moving average is the average price of a stock at a given time. When calculating a moving average, you specify the time span to calculate the average price. A simple moving average is calculated by adding the securities prices for the most recent X time periods and then dividing by X. For example, adding the closing prices of a stock for most recent 100 days and then dividing by 100. The result is the stock's average price over the last 100 days. This calculation is done for each period in the chart. If the stock's price is above its moving average, it means that investors' current expectations are higher than their average expectations over the last 100 days, and that investors are becoming increasingly bullish on the stock. Conversely, if today's price is below its moving average, it shows that current expectations are below average expectations over the last 100 days. The classic interpretation of a moving average is to use it to observe changes in prices. Traders typically buy when a security's price rises above its moving average and sell when the price falls below its moving average. The idea of this type of moving average system, buying and selling when prices breaks their moving average, is that you will always be on the right side of the market. Prices cannot rise very much without the price rising above its average price. The disadvantage is that you will always buy and sell late. If the trend doesn't last for a significant period of time, typically twice the length of the moving average, you will lose money. An indicator is a mathematical calculation that can be applied to a stock's price and volume fields. The result is a value that is used to anticipate future changes in prices. A moving average fits this definition of an indicator. It is a calculation that can be performed on the stock's price to yield value that can be used to anticipate future changes in prices. Moving averages are examples of trend following or lagging indicators. These indicators are superb when prices move in relatively long trends. They don't warn you of upcoming changes in prices. They simply tell you what prices are doing, in example rising or falling, so that you can trade accordingly. Trend following indicators have you buy and sell late, and in exchange for missing the early opportunities, they greatly reduce your risk by keeping you on the right side of the market. A moving average is an indicator that shows the average value of stock's price over a period of time. When calculating a moving average, a mathematical analysis of the stock's average value over a predetermined time period is made. As the stock's price changes, its average price moves up or down. There are 5 popular types of moving averages: simple, also referred to as arithmetic, exponential, triangular, variable, and weighted. Moving averages can be calculated on any data series, including a stock's open, high, low, close, volume, or another indicator. A moving average of another moving average is also common. The only significant difference between the various types of moving averages is the weight assigned to the most recent data. Simple moving averages apply equal weight to the prices. Exponential and weighted averages apply more weight to recent prices. Triangular averages apply more weight to prices in the middle of the time period. And variable moving averages change the weighting based on the volatility of prices. The most popular method of interpreting a moving average is to compare the relationship between a moving average of stock's price with the stock's price itself. A buy signal is generated when the stock's price rises above its moving average, and a sell signal is generated when the stock's price falls below its moving average. The critical element in a moving average is the number of time periods used in calculating the average. When using hindsight, you can always find a moving average that would have been profitable. The key is to find a moving average that will be consistently profitable. The most popular moving average is the 39-week or 200-day moving average. The length of moving average should fit the market cycle you wish to follow. You can convert a daily moving average quantity into a weekly moving average quantity by dividing the number of days by 5. In example, a 200-day moving average is almost identical to 40-week moving average. To convert a daily moving average quantity into a monthly quantity, divide the number of days by 21. In example, a 200-day moving average is very similar to a 9-month moving average because there are approximately 21 trading days in a month. Moving averages can also be calculated and plotted on indicators. The interpretation of an indicator's moving average is similar to the interpretation of a stock's moving average. When the indicator rises above its moving average, it signifies a continued upward movement by the indicator. When the indicator falls below its moving average, it signifies a continued downward movement by the indicator. Indicators, which are especially well suited for use with moving average break systems, include the moving average convergence-divergence, rate of change, momentum, and stochastics. A simple or arithmetic moving average is calculated by adding the closing price of the stock for a number of time periods, in example 100 days, and then dividing this total by the number of time periods. The result is the average price of the security over the time period. Simple moving averages give equal weight to each daily price. An exponential or exponentially weighted moving average is calculated by applying a percentage of today's closing price to yesterday's moving average value. Exponential moving averages place more weight on recent prices. Triangular moving averages place the majority of the weight on the middle portion of the price series. They are actually double-smoothed simple moving averages. The periods used in the simple moving averages varies depending on if you specify an odd or even number of time periods. A variable moving average is an exponential moving average that automatically adjusts the smoothing percentage based on the volatility of the data series. The more volatile the data, the more sensitive the smoothing constant used in the moving average calculation. Sensitivity is increased by giving more weight given to the current data. Most moving average calculation methods are unable to compensate for trading range versus trending markets. During trading ranges, when prices move sideways in a narrow range, shorter-term moving averages tend to produce numerous false signals. In trending markets, when prices move up or down over an extended period, longer-term moving averages are slow to react to reversals in trend. By automatically adjusting the smoothing constant, a variable moving average is able to adjust its sensitivity, allowing it to perform better in both types of markets. In this video, I've shared with you some basic informations about moving averages. There are many profitable strategies built around the concept of price breaking one moving average. However, more sophisticated traders are successfully using systems which are combining two or more moving averages. This type of approach very often involves optimization of parameters, sometimes even on the daily basis. In my next video, I will show you how you can incorporate moving averages into your trading strategy as a type of trend filter and enter the market using only price action techniques. If you are new to this channel, consider subscribing. You might also want to visit my website and check the free copy of ebook about financial markets. I hope to see you soon.